Well, guys, listen, thank you so much for joining us tonight. Gerald said my name's Brian House. I am the CEO and co-founder of MWR Financial, and I am extremely excited about the call that you guys, or the webinar that you're all getting ready to watch, and also what you're getting ready to hear tonight. For most of you, you already know that we have introduced our private reserve account with WealthMax, and so we're going to be talking about that a little bit tonight, but we're going to be giving you basically a complete overview of WealthMax. And I'm going to start out by saying that our WealthMax program with Financial Edge is focused on providing people with the best ways to save, grow, and protect their money. And our private reserve account adds a couple additional features there by making it to where it's tax-free with no risk of loss. And so that was something that we wanted to make sure that we offered to our members because obviously we are in the direct sales industry, the network marketing industry, and promoting our Financial Edge membership as well as our opportunity. We couldn't add a program that would actually have the ability for people to lose money. With that, it could cause you to lose people in your organization. And so we wanted to provide a secure way for people to be able to save, but at the same time, we wanted to provide the best in the industry, not just any program, but the best program. And you guys are going to hear about that, obviously, tonight, and we're extremely excited about it. Let me first of all say that Jordan Goodman, we wanted to get him on here tonight. He had a previous engagement, but guys, WealthMax is headed up by Jordan Goodman. Jordan is America's Money Answers man. He actually provides wealth building calls for all of our members. We typically do those once a month, which we're getting ready to start back at the beginning of the year. We're going into our holiday season, so Jordan will be back right after the beginning of the year. He's also putting together a financial library for us, a video financial library that you're getting ready to see in your Financial Edge portal under WealthMax Member Access. You're going to see that coming up before long. In the meantime, though, I'm going to take you to our back office here in just a second, but I wanted you to pay attention to our membership page that we've upgraded. We actually show WealthMax on there with the private reserve account. We've added that video. For those of you that have not seen the private reserve video, I definitely recommend that you check that out. It's a great video, provides great information, but tonight you're going to hear it from the man himself, and we're excited. We've got Rob Hodges on here with Cal Choice, our partner company that provides the private reserve account. And so, guys, I highly recommend you get a pen and a piece of paper together because you're going to want to take some copious notes here in just a second. But before we get to that, I want to show you guys how to access your WealthMax member access area. When you log into Financial Edge, I'm logged into a test customer site. You click on the Member Access button below WealthMax and go to the WealthMax Member Access area. It's our resource center. You're going to be able to see recorded calls in here that Jordan has conducted for WealthMax, or that I've conducted. You're also going to see an introduction to the private reserve account with our video. And one of the most important things I want you to pay attention to is our Schedule a Consultation Today button that's over here to the right. Now, you've got some additional information down at the bottom about our private reserve, but we don't provide a whole lot of information other than our video and some basic information about the private reserve account because we want people to schedule a consultation. Now, I'm going to tell you why this is important. With our program, you guys are very aware that we have the ability to help people create cash flow through savings when it comes to maybe tax reduction because of business ownership, going through our MoneyMax program, or maybe by helping them restore their credit so that they can lower their interest rates and their monthly payments and their car insurance and homeowners insurance premiums. Well, all of those things are incredible, but they create cash flow that can help you accelerate the debt elimination process, and they can also help you start saving for retirement. And this is one of the final pieces to our plan of action that we have in place that is specifically designed to take people from where they are right now financially to wherever they want to be financially. And this is a very, very important part of that plan of action, a very important part of our program, and it's the piece that I honestly believe people should start with and they should finish with. Now, what do I mean by that? Well, planning for your retirement or putting yourself into a position to be able to retire in years instead of decades, or being able to retire on your terms, requires having a plan of action in order to be able to do that. And so what we want to do is we want to find out what you want to accomplish or what you want to have available to you when you retire. By doing that, that's going to help you map out a game plan with our program, with our opportunity, with our services, savings, additional income. That's going to let you know what you need to accomplish in order to get to where you want to be at retirement. And so it's important to know how much money you need at the age of retirement, whatever that age is. For some of you, it may be in the next 5 years or the next 10 years or the next 20 years, but you need to know what that number is, and our retirement specialists with Cal Choice can actually give you that roadmap. They can tell you, structure a plan for you that is designed specifically for you, letting you know what it's going to take in order for you to accomplish your retirement goals. With that, we're going to break this call into a couple of parts tonight. You're going to learn how our private reserve account, how our retirement specialists with Cal Choice are able to help you accomplish your retirement goals. You're going to learn also how you can use WealthMax, our private reserve account, to build your MWR financial business, and how there are additional income streams that are available to licensed agents, licensed life insurance agents that want to participate in our program, or maybe you want to become a licensed insurance agent. All of these things are possible through this program, but it's going to open up some doors to you that's going to give you a niche. It's going to give you the ability to present this program to people that are in the life insurance industry, and they're going to be extremely impressed. One, because we have the ability to create customers here through our services. Instead of going out there and trying to tap into that 22% of the population that has expendable or savable income, our program allows a licensed agent to be able to create clients out of that 78% by helping them create cash flow or increasing their income. So that's something that we're extremely excited about. One of the reasons we partnered with Cal Choice on this. Those agents are going to be able to participate in a compensation plan that is unlike any compensation plan I've seen in the insurance industry or in the network marketing industry. So with our program at MWR Financial, you have your MWR Financial compensation, but you also have the ability to create an opportunity within our opportunity that will allow you to earn even more, and which is beneficial both to our existing MWR Financial consultants, but also it's extremely beneficial to agents out there who want to be able to earn an income while they're preparing clients to be able to participate in a retirement program through Cal Choice, and how they can actually license here with us to be able to work with Cal Choice. So I've kind of laid the groundwork. So what I'm going to do now is I'm going to switch this over to my good friend here, Mr. Rob Hodges. I'm going to give him a proper introduction here in just a second. But I'll tell you what, guys, before Gerald goes, Gerald, are you still there?
I'm with you, Brian.
Okay, listen, I'm going to have you hop off of the moderator side here in just a second so we can turn this over to Rob.
Sure.
Before I do that, listen, I've talked about how great our private reserve is, how great WealthMax is, but if you would, I'd love it if you just share your testimony, what this program has done for you, because I know once you plugged into this, it got you extremely fired up, and you have been going to town building an MWR financial business. But just tell everybody what this program means to you and what kind of impact it's had on your life, buddy.
Brian, listen, best financial decision I've ever made. I'll tell anybody that. I would have never had access to the ability to open a private reserve account had it not been for MWR Financial and the financial experts that this program has surrounded me with. As a result, I mean, I've basically secured my retirement, and I was on track working on a job and still there for now. But because of MWR Financial, I know that I don't have to be here much longer. But here's the thing. investing into a 401k that's not giving me a great return. Looking at my numbers, I would have physically had to work another 20 to 25 years. That's a long way away, man, at 55 years old. I knew I couldn't do it. I didn't have it in me. I needed another vehicle that would get me there quicker. The private reserve account is going to do that. Just projected numbers based on what this fund has done over the past 10 years. I'll cut that time of retirement in half. So having to work 25 years, that's out the window. Never again. I could do this in 10 years. But the beautiful part about the private reserve, that we have the ability to speed that process up and close that gap even further, because I have the ability. I'm in total control now. I'm the bank. I can put as much money in as I want to without being penalized. For example, my 401k, those of you who haven't, you understand it. You're going to be heavily penalized if you go to pull that money out. I'll have to create some sort of hardship situation in order to even have access to my own money. And the rate of return is just not going to get it. And I just feel it's by design. It's just set up to keep me there and not allow me to grow as fast as I need to grow. But there are no limitations with the private reserve. I mean, I can actually have access to my own money, borrow money that I'm putting against the money I'm putting in, and then have the ability to turn around and determine what is the rate of return that I create, because I'm in total control of the situation. So I'm basically the bank now, handling my own money as a result of this private reserve account. But it's just phenomenal what it's going to allow me to do, the things that I want to do from here with it. It just blows my mind. There's no end now to what I can do and where I can go with my financial life, and it can be secured through this private reserve account. Again, one of the best things that's ever happened to me, and I wouldn't have had the ability to do this walking off the street into some financial advisor's office and having to pay $150 to $200 an hour. My MWR financial membership gets me access, gets me this. And it's funny, the gentleman who's my rep with Cal Choice, I kind of asked the question while we were going through the process of how long you guys been doing this, and he kind of chuckled, much like I am now. And he was like, Gerald, this has been around forever. Where I've been, sleeping under a rock, evidently. I mean, why didn't I know about this? I mean, why didn't I know about this 10 years ago? This program has been around forever, but we just don't have access simply because we don't have these financial experts in our lives. And that's why MWR is where people need to be. And, Brian, you and I have talked about this. I'm convinced the only reason that everybody in America is not part of MWR Financial right now is simply because they haven't heard about it. I'll give it back to you, sir.
All right, amen. And Gerald, I appreciate that greatly. And guys, listen, it's one thing for me to talk about how great this program is. It's another thing for you to be able to hear it from somebody that has experienced it firsthand. And Gerald has obviously done that. Guys, Rob is a executive vice president with Cal Choice. I've been working with Rob since we partnered with Cal Choice, and I'm telling you, this guy is a plethora of knowledge when it comes to this program. He helped structure our private reserve that we're working with, and so there's nobody better to explain it. So, Rob, with that said, listen, I appreciate you a bunch taking the time tonight, and I'm going to turn it over to you, and I'm going to take some notes myself, because every time I hear you speak, I learn something new, and I love it. So, but call is all yours, buddy.
Well, great. Thank you, and thanks, everybody, for attending tonight. So we're going to take just kind of a dig into the private reserve account tonight. We'll do some of it from a high-altitude level, and we'll get down, and I'm going to give you 3 specific examples of some things we can do with the private reserve account. And there's 15, 20 different things that we can accomplish with the private reserve account, and I'm constantly looking at new ways to fund it, new ways to use it. But tonight I will give you 3 specific examples of what we do with the private reserve account. So what I want you to know tonight is going to just give you a brief education on making retirement years comfortable and secure, and enjoy the ride along the way. Now, so far, you start reading through the things that I'm going to point out here: how to avoid being the victim of harsh volatility, plummeting stock market and home values, why decade-long stock market booms are dead, addressing and solving financial money usage failures, and creating banking and borrowing alternatives, and most importantly, leaving a legacy to your family. This may sound like any other company out there, Some of these are kind of some generic statements. Some of them are really zeroed in on certain things, especially leaving the legacy to your family. But I want you to, as we're going through this evening, recognize that very, very few people in the financial services industry know what I'm about to show you this evening. And being privy to this information will give you kind of a jump start and an arsenal in your back pocket that nobody else has. But I want to do just a little bit of a foundation this evening. I want to talk about average rate of returns simply because that's all anybody ever hears. The messaging in the financial services industry has always been, currently is, and in my opinion always will be, built around average annual rate of returns, whether it's the bank, a registered investment advisor, an insurance company, a mutual fund. They all talk about average rate of returns, and here's how it works. Average is calculated by a given period of time. Here we're going to use a 4-year period of time. You add up all of your positive years. You subtract all of your negative years. In this example, we got years 2 and 3 were positive 50%. Years 1 and 4 were negative 50 and negative 30 respectively. That gives us 100 minus 80. That's a 20% return over that 4-year period of time. We divide that by 4. We have a 5% average annual rate of return, and that is exactly how it's calculated with mutual fund companies, banks, registered investment advisors, etc. Typically, they won't just show you a snapshot of 4 years. They'll show you a decade or more, and we're going to get into that as well. The actual rate of return, however, by the way, your $100,000 should have grown to about $121,550 if you got a 5% rate of return each year. But here's what actually happened on that money. If we were hit right out of the gate with a minus 50% rate of return, our $100,000 is now worth $50. Yes, we did get a 50% rate of return in year 2, but it was only on $50,000, which brought us up to $75,000. We got a 50% rate of return again in year 3, which took that $75,000 up above our $100,000 initial investment. But then we were hit with minus 30% in year 4, dropped that 112 down to 78,750. Our actual return was minus 21.25%, or $21,250 we lost, averaging 5% a year. Nobody ever looks at this. So imagine this over a 10, 15-year period of time, what that looks like. We talk about the lost decade. And I'm going to show you what happened from years 2000 through 2009 in one of the most favorable places that investment advisors will put our money, and that's something called the S&P 500. Well, the S&P 500, if we start in the year 2000, actually lost 9.11% in 2000, almost 12% in 2001, and 22.27% in years 2002. Now, it recovered 2003 through 2007. Wouldn't it be nice to participate in a 27% rate of return, 10, almost 5, 15, and 5.46? Those were great years in the S&P 500. 2008, you all remember what happened in 2008, both in the housing market and in the investment market. The S&P 500 lost 37.22% and recovered in 2009 with another 27.11%. Our total return over that 10-year period of time was 11.06, or an average rate of return of 1.06%. But here's what it looked like. If we had put $100,000, this could be $1,000, $10,000, doesn't matter. We just use $100,000 in this example. This is what the ride looked like. Our $100,000 dropped to around 60, and then we held on, and it rose back above 100 to about 112,000. And then we lost again in 2008. Money went back down, and we recovered with less than we actually put in the S&P 500. So here's the real story, guys. This is what actually happened. I've been in this business 29 years, and I'm going to tell you what actually happened. People had money in the stock market, in mutual funds, 401ks, S&P 500. And when that first year of 2000 hit, they were all reaching out to their money advisor or meeting with their 401k representative at that meeting that HR puts on every year for your 401k. And they're asking those professionals, what do we do? We just lost 9% on our money. What do we do? And every single person gave them the advice to invest more. Now is a great time to buy. The market's down. Put your money in. So they did it. They reached out to those financial professionals again at the end of 2001 and said, hey, I just lost another 12% return on my money. And those advisors said, that's okay. Put more money in. Now's the best time to buy. And they very sheepishly followed that advice in 2001. And I'm telling you, I was around this business when this all happened. And then when 2002 hit and they lost another 22.27%, there was no call to the advisor. There was no checking to see what to do next. They all moved their money out of the stock market, out of their 401ks, and they parked it in cash. And then they sat on the sidelines and listened to all of the talking heads in 2003, 2004, 2005, telling how great the market's doing. And they're sitting on the sideline watching, waiting. 2006 comes around and they said, you know what, we got to get back in. They jumped back in, had a decent year in 2006, a decent year in 2007. They got hit with 2008. Those people ran for the hills. They'll never put their money back in the market. And they missed that 27% return in 2009. That's the real story, guys. People buy high, they sell low because they are all operating on their opinion in their gut, and they're reacting instead of acting. They're reacting to the market. There's a better way. I love the S&P 500, but I hate losing money. We entered it, by the way, that $100,000 over that 10-year period of time. At the end of that 10-year period of time, if you did the roller coaster ride, you had $90,000. That's why I call it the lost decade. You had less than you put in at the beginning. We've got a solution for this, and we introduce people to a concept called indexing. In this example, we're going to use the same index, but we're going to approach it in a different way. We're going to approach it with a concept called indexing, and basically what that means is in these years where the market lost money, you lose nothing. But in the years when the market does well, you get the first 14% in this example. So this year right here, let's take these 3 years, negative, negative, negative. Your $100,000 maintained its value, and you started earning money again from $100,000, not down here from the 60. The market gave a 27.72% rate of return. You got the first 14% of that. In 2004, you got all of the 10.82, all of the 4.79. In 2006, you got 14 of the 15.74, all of the 5.46, none of the 37.2 on the downside, and you've got 14% of the 2009 return. Look what happened. Our money's tied to the same index. We only get the first 14% of the ups, but because we lose nothing on the downs, our $100,000 was worth over double in an indexed account than what it would have done in the actual S&P 500. So this concept, this design becomes very important as we talk about the private reserve account, because that's exactly where we help people get their money, is into an indexed account tied to the S&P 500. We're teaching people how to move out of the traditional banking concept, because with that comes low rate of returns on our money. They lend our money out to other people. They pay us 0.5% maybe. They turn around, leverage it 10 to 1, and loan it out and collect 8, 10, 12, 15% on our money, loaning it out to other people. Guys, that's a concept called arbitrage. Works really good in the bank's favor. We must qualify to borrow money from the bank, and typically when we need it the most, they're not interested in loaning it to us. Banks only want to loan money to people who don't need it. They can get it anytime they want. People that do need it, which is most of us, have a very difficult time getting the bank to loan it to us. We understand that we have to pay interest on that money that we borrow. We also understand that the bank sets the loan terms on that money. If we use it to buy a car as an example, and we don't follow their guidelines of making those payments, ultimately they're going to come and take the car. Dollar serves one purpose when it's in the traditional bank, and that's to make money for the bank. Now, I know you're all on mute right now, but I can guarantee you there's not anybody that has any issue with this. This is exactly how banks have worked for years and will continue to work this way. We introduce people to a concept of the private reserve account where their money's linked to the market. That S&P 500 that I just showed you with a 14% of the ups and none of the downs is paramount in the private reserve account. You want to borrow money, you don't have to ask anybody. You simply send a request and they send it. You have the ability to continue earning interest on that money that you borrow, effectively creating arbitrage for yourself. You might pay 4% and earn 14%. I'm going to show you what that does for you here in a minute. It's phenomenal. Do what the banks have been doing for decades. Do it within your own private reserve account. You set the loan terms. If you borrow money to buy a car and you get in a bind and can't make that payment for 6 months, a year, or 2, you don't lose the car because you set the loan terms on paying that money back. You have tax-free withdrawals. You don't have to wait to age 59 and a half to access your money. You can access it at any time. And your dollar now has the ability to serve multiple purposes. And that bottom line is to make money for you. So guys, given the option of the traditional banking and the private reserve account, if an account truly works this way, ask yourself this question. How much money do you want there? The typical answer that I get back with this is as much as possible. And how soon do you want to get it there? The answer generally is as soon as possible. So tonight's going to be about giving you a couple examples of how things work. There's 4 phases to getting the private reserve account going. Phase 1 is the design and approval phase, and I'm very involved with this with MWR clients and prospective clients, is working with the financial professionals to specifically design a private reserve account for that particular client. It is not a one-size-fits-all. We custom design it for each individual. We first have to determine the goals, figure out, okay, how are we going to fund it? How much money do we have available on a monthly basis? Is it $100 a month? Is it $1,000 a month? And we'll build it accordingly. We're going to follow the IRS guidelines, and we're going to see here that there are specific guidelines to the private reserve account. We follow those to a T. What is your need for insurance? Are you insurable? Those are 2 factors we need to look at, along with some others. And we want to make sure that you are working with experienced financial professionals. That's what we have here at CalChoice, and we're also teaching a number of people with MWR that are licensed to be these experienced financial professionals and follow these TEFRA, DEFRA, and TAMRA guidelines. These are the IRS guidelines that we follow very, very closely. These were acts that were put into place in 1982 and 1984. And I want us to look at this right here. The IRS has actually set up a code, 7702 private plan. This is like a retirement account. You'll notice that DEFRA is one of the reasons we can point to as evidence that cash value life insurance, which the PRA is an insurance policy from a tax-preferred wealth accumulation strategy, works. In fact, it works so well the federal government felt compelled to act on placing limitations on one's ability to place money into the account. Now, you heard earlier on the call that you can put as much money in there as you want. You can, but yet the IRS limits the amount you can put in. So how do those 2 things work? I'm not going to cover that this evening, but there is no limit to the amount of money that you can contribute, and we'll work with that with you as you move through the process here. TAMRA came into effect 1988. Again, I'm not going to spend a bunch of time here, but those of you that may be looking at this when I'm done this evening saying, oh, that sounds too good to be true, the IRS is going to crack down on that to where it doesn't work like it does, they already did in 1982, 1984, and 1988. These guidelines have been in place for a couple decades. They're not going to change. The IRS has already drilled down on this as far as they're going to. Phase 2 is where your premiums begin. They go direct from your account to the insurance company. You're going to complete a minimum of 4 to 5 years in the private reserve account. You certainly can fund it longer, but we're going to ask for a commitment of at least 4 to 5 years. Phase 3, we're going to max fund that. Now, that's very important. You may run out and talk to another insurance agent that may understand how IRS Code 7702 works, or they think that they do. We're going to talk about max funding. This is the key, and I will tell you probably less than 0.5% of the agents out there do it. Some of them know how, but they refuse to do it because they take a hit in their pocketbook as far as commissions go. CalChoice Financial does it 100% of the time, max funding it. You're going to fill that policy for 4 to 5 years. You're going to meet with your financial professional yearly. You're going to stay disciplined. Then phase 4 begins, where your profits and distributions can begin. Access your PRA account tax-free. You have potential continued earnings on the money that you pull out of the PRA. That's that arbitrage that we talked about. There are no early withdrawal penalties, nor are there required mandatory distributions like there are on every other type of qualified account, and you establish the loan terms. Now, I'm actually going to slide through this one really quick. I don't want to cover that one this evening. Let's talk about an example that we all know very, very well, and that's buying a car. This is the way automobiles have been purchased for decades, and if people don't know any different, this is how they're going to continue to be purchased for decades to come. We need a car. We go to the bank. First, we find a car that we want. This is using a $25,000 example. We convince the bank that we're loan worthy. They give us a loan for $25,000. We enter into a contractual agreement for 5 months that we will pay $483 a month for 5 years, $483 a month for 5 years. We understand and we agree to, if we don't make the payments on that they will come and take the car. We understand we're going to pay $3,260 in interest, although none of us ever really look at that over that 5-year period of time. And we're out of pocket $28,260, and after 5 years, what do we have? A used car. We may drive it for another year or two, and we turn around and trade it in for pennies on the dollar, and we do this process all over again. Those of you who have adult children, we've taught them to do the same thing. Those of you that have grandchildren, they're doing the same thing. This is a legacy that's been built in our society because there's been no other way to do it. We show people use your private reserve account to buy the car. Now, obviously, this is predicated on you having $25,000 in it. So some of you on the call this evening, this may take you a few years to get to this point. That's all right. Start with what you have, use it, and grow, and get to a point where you can start using it in an example that I'm showing you tonight. Take the money out of your private reserve account. You were going to pay $483 a month here. Pay $483 a month here. Only pay the money back to yourself. You will retire that loan in 58 months. You'll save about $966 in payments. But remember that arbitrage that I talked to you about earlier. That money from years 2000 through 2004, and if you remember the lost decade example that I just gave you, 2000, 2001, 2002 were negative returns. The market only earned profit in 2003 and 2004. That $25,000 that you used to buy the car earned $3,100 in interest while you used it. That's a $4,000 difference in your pocket versus the traditional way that people are buying cars for decades. But let's look at a different 5-year period of time. This is arguably one of the worst 5-year periods of time in history. Let's look at one of the better 5-year periods of time in history. That would have been from 2010 through 2014. Same example, $25,000, $483 a month to pay it off. That $25,000 earned $15,156 while we used it to buy the car. In that 5-year period of time, that's a $16,000 difference. Guys, if all we did was teach American families how to do this, just this one concept with the private reserve account, I think you all would agree we could change families' legacies forever with this type of concept. But let's not stop here. Let's look at something else that we're all very familiar with. The traditional college savings plan. The name of choice, the product of choice in 2017 is a product called a 529. Here's an example where we fund that 529 at $250 a month from age 0 to age 18. And at age 18, if we did a look back over the past 18 years, there would be about $95,000 available for college. Most people don't know this, but a 529, 100% counts against the student for student aid. So that money actually makes the ability for them to get student aid less viable than it does if they hadn't to fund the 529 at all. There's no death benefit. Why would there be? It's a college savings program. We're going to make an assumption here that once that student completes college and reaches age 26, that they start contributing $500 a month to a retirement program, 401k as an example, from age 26 to age 65. They would have about $2.4 million in a taxable account for retirement, and again, no death benefit. So we laid it out from age 0 to age 65, $250 a month for 18 years, take the money out to pay for college, then invest $500 a month into a 401k from age 26 to age 65, $2.4 million in a taxable account. At no point in time was there ever any death benefit if that person were to die. Let's compare that to the private reserve account alternative. The same $250 a month from age 18, 0 to age 18. You'll see here with an 18-year look back, we have about $82,000 available for college. Now you may be going, I would rather have 95. Well, this $82,000 has no effect whatsoever on student aid. And remember, this $82,000 continues to earn interest while we use it for college. This trumps this 100% of the time because of those two benefits. It also has a death benefit of $500,000. Nobody wants to lose a child or a grandchild, but if we do, there's a $500,000 death benefit. We're now going to make the assumption that that student, again, starts investing $500 a month towards retirement, but instead of putting it into their 401k, they put it into their private reserve account that was established when they were born. They would have $2.5 million tax-free at age 65 versus $2.4 million taxable, and a $3 million tax-free death benefit to their family if they would die. I don't even have to hear the answers here. If we had the option between this account and this account, we would choose this 100% of the time. Guess what? Everybody would choose this 100% of the time. So you may have some children, maybe you have some grandchildren. Instead of buying them a gift, fund their private reserve account. It's going to benefit them over their lifetime. Start your child or grandchild's education retirement as soon as possible. Now I want to give you one more example. Pay attention here. This one is pretty awesome. The messaging in 2017 is to refinance your home into a 15-year mortgage. Quicken has it every single day on Yahoo. We hear it on the radio. We see it on TV. Companies are making a heyday of money getting people to refinance their 30-year mortgages into 15-year mortgages because interest rates are at historical lows. We're going to use a $300,000 home as an example. 15-year mortgage at 4% would be about $2,219 a month for 15 years. That $300,000 would be paid off. Now understand, in doing this, the homeowner is taking huge equity risk. Remember 2008 when banks were repossessing homes left and right? The more equity that's in your home, the more likely the bank would be to repossess that home if things got dire like they did in 2008. It minimizes the equity risk for the bank because it's all on the shoulders of the consumer. That's how a 15-year mortgage works, but our home is paid off in 15 years, which would be pretty nice. It also has reduced tax benefits to the homeowner because if the home is paid off, obviously there's no more tax benefits to that home. The PRA account works like this. Keep your 30-year mortgage at 4%. Your payment would be about $1,432 a month. Take that $787, which is the difference between the 15-year mortgage payment and the 30-year mortgage payment, and put that into your private reserve account for 15 years rather. Protect your equity outside the home. Leave the equity risk at the bank. grow your equity inside your private reserve account. After 15 years, by the way, you have a death benefit, $300,000, pays that home off tomorrow if you die. But after 15 years, the private reserve account now takes over that $1,432 a month payment. You are still relieved of any payments after 15 years. But at the end of 30 years, you've got $224,000 more equity in your home than you would have had in that 15-year mortgage. And obviously, both of the examples, the payment is gone after 15 years. I believe people will choose this option 100% of the time over a traditional 15-year mortgage. We do a lot of these mortgage acceleration alternatives with our CalChoice clients. You will have access to that as well. So, Brian, at this point, I am going to, I think, turn the controls back over to you if I can.
Guys, listen, I hope you pay close attention to what he said there because, obviously we talk about mortgage acceleration and accelerating debt payoffs through our WealthMAX program. But, Rob, I had a new mortgage that was at 15 years. I would probably refinance it at 30 and take the difference there and start putting it into a private reserve account. Leave the risk with the bank and use that money to be able to start saving for retirement through a private reserve, and you can still accelerate the payoff by 15 years and end up with a whole lot more. So I love it. I love it, and I'm excited about this next part because I know we also may have some agents on the line here, some life insurance agents that are interested in this next portion. But, Rob, I want you to go through the compensation with this, and I'm going to say this beforehand. Anybody that is involved with MWR Financial that wants to go ahead and partner with us with CalChoice, to do that, just simply send an email to support@MWR Financial indicating that you're an agent, that you'd like to participate, and we will send you the link and the information you need in order to be able to get started. Now, if you're introduced by an existing MWR Financial consultant that is already an agent with CalChoice, they will be able to help you get set up directly. But if you're not, let us know, and we will provide you with a link to be able to get started with this program, and you can benefit from both MWR Financial and you can be able to market the private reserve. So, guys, next week, what we'll do is we'll go through how to get set up as an agent, whether you're an existing MWR consultant that isn't licensed or whether you know licensed agents. We'll talk about this next week. And Rob, listen, I just want to thank you so much for taking your time tonight to be on this call. I want to thank Gerald. I know he's listening in. Guys, if you haven't scheduled a private reserve account consultation, definitely do that. I don't care where you're at with MWR Financial right now. Find out what it's going to take to get you where you need to be. And in order to do that, you need to schedule a consultation. So, Rob, anything else you want to add before we go, buddy?
No, I don't think so. I'm looking forward to speaking with you guys again and walking through our comp. I think you're going to be blown away by it, and hopefully we do have some agents on the phone, because I know when Ben saw it, he was like, oh, my gosh, unbelievable. And he's got a pretty decent-sized general agency going, bringing his whole team over because of the compensation and obviously all of the other things that we do. And our partnership here is getting stronger by the day, Brian. I'm real excited to continue working with you guys.
Hey, well, we're excited to be working with you guys too, Rob. And again, I greatly appreciate it. Guys, have a great night. Have a great rest of the week. Let's go knock it out of the park. Happy Thanksgiving to everybody if we don't talk to you beforehand. But listen, we've got a lot to be thankful for, that's for sure. And Rob, you're a big part of that. So thanks a bunch, guys. Bye-bye.
All right. Good night, guys.